macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen. Well, if you're considering buying a VIX ETF, our market timer Kevin Cook says you might want to think again about these vexing and vicious VIX vehicles. How do you like that for alliteration? He's with us now to talk more about it. So what's going wrong here with investors buying a little protection against all the volatility?
You know, we all want to have some protection because we have big downside moves, and if we want to stay long equities, we'd like a hedge of some sort. But these VIX instruments are not the best hedge. And I joke and call them vicious and vexing, but let's look at why, and we'll see where people lose money. Okay. First of all, what are we talking about? The VIX index is the implied volatility on S&P options at the Chicago Board Options Exchange. And that index is a combination of the front month SPX options and the second month SPX options, and it creates sort of a 30-day rolling forward expectation of volatility. Okay. Now, since it's using the prices of puts and calls and creating an implied volatility, it implies, put demand. Are institutional investors hungry for protection, buying puts to cover their long equity positions? Because institutions aren't going to rush out and sell all their stocks right away if they're worried, but they might buy some put insurance. And it's also then becomes an expectation of future volatility. So that's the VIX index, which you can't trade directly. Here are 4 different VIX ETPs. And now I'll say ETP sometimes for exchange-traded product because some are ETFs, exchange-traded funds, and some are called exchange-traded notes, ETNs.
I see.
Roughly the same thing. The first 2 are just based on the VIX. The UVXY and TVIX use leverage. So let's look at what happens here. We'll just look at the VXX, which is very popular, trades a lot of volume, not leveraged. Here's a 3-month performance comparison versus the VIX itself. Roughly in line. In fact, when I looked yesterday, they both lost about 25% in the past 3 months. Right now, sitting around there. The yellow line is the VIX. The bars are the VXX. So that's on a 3-month basis.
And yesterday is March 12th.
Right.
Okay.
Here's a 1-year comparison. And you can see the VIX losing about 15% and the VXX losing over 75%. Over time, these VIX vehicles tend to decay more. And decay is like the simplest word to use here. And what it has to do with is the fact that they use futures, and when futures are in a forward sloping upward curve, these products are selling the near month, buying the next one, and always paying up. And every day they lose a little bit more value.
Okay, so let's just recap here so people can understand about these vexing and vicious vehicles. You can't actually buy the VIX index.
No, you can't.
And these ETFs all use futures based on that VIX index.
Yes, they have to buy and sell the futures, what are actually VIX futures.
Okay. So what's wrong with the model, and why do they lure so many unsuspecting investors?
Well, most investors who are in the equity markets aren't also playing in the futures. So they may not even have an account that would allow them to buy or sell VIX futures. So these ETFs were supposedly the answer. Well, the institutions that created the VIX ETFs find new customers all the time. Yeah, and people are lured in. And I think it's almost a disservice not to tell people exactly the dangers of them. But actually, some brokers are taking the initiative and say, no, for customers to trade these, we need to have a very high minimum balance. It needs to be speculative money. You can't trade it in IRAs, that kind of thing. So let me show you the real problem here. Now, this is a look at VIX futures and the forward curve, where let's say that the spot month VIX is at 12 or 13. Well, the next month, let's say it's April, might be priced at 14. And the next month after that might be 15 or 16. And so that forward curve has a steepness to it. So these VIX products that track the VIX, they're continuously having to buy new VIX futures, but they're selling the ones that are lower priced and buying the higher priced ones day after day as they roll forward. and they're always losing value. And the smart institutions are sellers of these VIX products for that reason. So this is called contango, when in any futures product, when the futures curve is sloped upward and the farther out months cost more than the near months, that's called contango. And that's one of the essential problems with any ETFs that use futures to gain their daily returns.
So is there ever a time to trade these?
I would say very rarely. It's really for people who understand volatility very well, probably people who trade a lot of options, which means they do understand volatility very well. I actually own the TVIX right now.
Okay, so you trade them.
Yes, for a very quick trade, but it's something where you have to be very nimble. Your timing has to be very good, and if you're wrong, you have to know quickly when to get out. Let me show you. This is a very dramatic example. Now we're going to look at a leveraged VIX ETF. Before we looked at the VXX, which is not leveraged. It just tracks the VIX 1-to-1. Here's the TVIX, which tries to get a daily 2 times return on the VIX futures. This is since inception, and you can see that the TVIX cost $1,100 in November of 2010. And just about in October of 2011, it was also trading for $1,100. After a trip down to $300, it went back up to $1,100. Now it's trading for under $4. And people, unsuspecting people, look at this and say, wow, it's so cheap. Now if volatility goes back up, I could make a killing here because this thing could skyrocket again. Maybe it'll go back up to $50 or $100. And that's not really the case. The reason that those past prices are so high is because this index had to do a reverse split, 1 for 10. Had to multiply its shares by 10, reduce its shares by a factor of 10 just to get the price back up before it went to 0. TVIX was in danger of going to 0 last fall. In November and December, it slipped under $1, and that's because of this decay. It just keeps getting pounded, and the institutions keep selling it because they know it's going to 0. So the sponsor, Velocity Shares, had to do this reverse 1 for 10 split and get the price back up by reducing the number of shares. So that's what they did. You can see the dollar sign there in December. Now at under $4, TVIX is probably destined to go to $1, and they'll have to do another reverse split to keep it alive. So that's how. This is a good example of how dangerous these things can be, and you really have to either go out of your way to understand them or just stay away from them completely.
All right, words of caution from our market timer, Kevin Cook. You can follow him on our website, Zacks.com. You can follow him on Twitter at Kevin B. Cook. He's also on StockTwits. He's all over the place. With Kevin, I'm Terry Ruffalo.